Hey, how are you guys? This is EURUSD. You're with Francis Hunt, the market sniper, and I'm going to run you through a recent history of the euro from roughly the 2015-16 era, which was a very poor and weak time for Western economies, and the great Shanghai Accord was struck as well after China had pumped heat into the economy, the global economy, post the big blow-off of 70809, and they eventually ran out of puff in mid-15 and then conceded. So 16 was an era where the euro hit a very, very high level of weakness relative to the dollar. In fact, the low that was here on that particular day was, if you look up at the top left-hand corner there, around 103,402. So for those of you that are impatient and are in a hurry and don't want to understand what I'm doing, my expectations is that we will trade in the 103s again on a dollar shortage basis. Some of you might think, why? Let's go through the happenings of those events technically in the recent realm. So following that low that was in the beginning of January 17, what happened? By the way, if you want a Sniper Circle shirt, grab it on the links below. Yes, let's get the brand out there. Reset season is here. Be part of the awake many. So what happened? Let's switch on the light. There's going to be a lot of draws on here. It's going to be a little bit overwhelming. Essentially, you came up to the 116 level. This right shouldered and set up what we call an upside HVF that generated a target up top here. So a little bit of scribbling with you. That's all in here. And then led to a high over there for the euro. At these giddy heights, this was up at the 125s and through for the euro USD. That's right, the euro USD did in fact trade 125s. Not that long ago. It was the peaks of 18 during that period, sort of early doors, first quarter 18. What else then happened? Well, let's run you through the items as they come up. We then got this red grind line. It was the first inverted in a new trend, and you got absolute overperformance, and you threw it back down. That's a hammer. And that hammer also just ran the key level of significance, the blue line, which is 116. So that actually set up structure for a head and shoulders. So once again, let's do this scribbling in a manner that you can understand, where there's not too much information on the chart. Head up top here, very grindy, first inverted in a new trend, major overperformance, and you ran that key psychological level. It was 116, 115, also a big level, but a little further down, and this armpit here did not make it to the 115 level. So we take the first logical round level that meets horizontally all of them. We do not engage with angled necklines. Markets do not care about things that have variable prices at different time points. They care about price points. You got a very weak right shoulder, a stuffy little weak right shoulder right in there. It did an initial break, boom, there, feigned back in, failed to run your stop, although it would have been a nervy start for you during that period on the head and shoulder before it rolled over and then made a new low. It's kind of how you went. Got a little bit of continuation structure in here, further on down. Now you might say this isn't the most impressive head and shoulders in terms of rate of performance to the downside, and you would be absolutely correct, in which case why am I calling further downside at this low level down here at the 108.7s, which is another good question. So let's deal with them. I'm going to clear that screen and I'm going to bring back some further lines, but before I do that, a short sidebar. Politically, during this period, Trump, as new president, 16 era, 17, 18, went to Merkel and Germany and said, do not seek to get a currency effect benefit for your personal economy at the expense of Americans. In other words, Fords must not be outsold by BMWs and Mercedes on account of the fact that you have a weaker currency, only on account that they're better cars, for example. And as a result, Merkel was chastised, and it was quite an icy meeting where Trump certainly was looking to make a point. This was a political event. Now, actually, the truth be told, outside of Germany, most of Europe needs a weakening euro. In other words, The Spanish, the Portuguese, the southern Mediterranean states, Greece certainly, Cyprus, and many of those along the south actually desperately needed a lot weaker currency, and Germany was a sort of a small, large, I should say, given the scope of its scale, large oasis in a desert and needing water in terms of currency strength. What typically that means is there should be no disorderly and very abrupt loss of value of the euro to the dollar. So what that probably in my worldview signaled is that there could be small, quiet and slow gains for the dollar against the euro in not too disorderly a manner. In other words, the conduct of the ECB versus the Fed and their coordination between each other and fiscal announcements by various different politicians should only allow for minor increments to be gained. And this is one of the reasons why I suspect it's taken so long for this head and shoulders to meet target in terms of how it's going. Of course, it could be wrong. It's speculation on my part. I'm just trying to make sense of all that goes on around us. So let's clear that and go back and have a look at those lines. So the eventual target, the one that we drew here on the round number that was violated by both the left shoulder and the right, was recently made, good people. It was recently made. In fact, we tweeted about it. If you're not following at the Market Sniper, at the Crypto Sniper, and at the Reset Sniper, you wouldn't have heard. But we can't do YouTubes just for single events all the time. They take a long time to do. But that was a key event. And it was something that when the initial trigger took place, running through that 116, that, and we're on a weekly chart, was 30th of July 2018. Yes, that far back. You're talking 18 months, the better part of 18 months into quarter one of 2020 for that initial triggering event to finally deliver the target. I'm telling you all this because we're going to drop down time frames and we're going to see these events and these purple lines that we use for target annotations in a small bit. Okay, so that head and shoulders did eventually perform. However, not without a bumpy ride. There were a number of draws that we did. There were smaller, less aggressive ones that made targets sooner, certainly. We have a number of different reasons of how and why we do multiple head and shoulders and which ones are the most dominant. But the 116 projection is the one I'm happy for you to go with in this instance, and it was the final one to be made. And the target that it required was 106.44. Now you may recall from previous history that when you're down in these levels, there was a lot of defense, and the great fear of the parity run sees 103 that I've highlighted as a low, as a very strong defense point for which the dollar is uncomfortable to gain too much ground against its almost polar opposite rival. In other words, so many people that are in small emerging nations have to decide which of the major currencies, and the euro is a second choice. I wouldn't say a strong second choice, but it is a second choice. So when things are really looking bad for the dollar, a lot of more money might get parked up in euro. Yes, it can be in Swiss francs, Singapore dollars, New Zealand dollars, and pounds as well. But as for liquidity purposes, on a big scale, the super macro, the institutions, the corporations with their treasury, they will regularly move money backwards and forwards between the euro USD. So they are in essence substitutes for each other in terms of big treasury operations. Let's bring it right down. We'll go through the daily to highlight some of the recent events, reframe that chart and bring you up to date. So just to re-highlight to you what actually happened, here is that vent of the target being made. You can see it. And prior to it being made, an earlier, less aggressive read on our head and shoulders was up top here, and actually after making that target we had a huge euro run that ran all the way up to the round number of 115. There's your 116 neckline right there. Imagine waiting the better part of over a year and getting almost to target, only to have to sit through drawdown all the way back up to literally your triggering event, which was 116. Very close there too. Amazingly, as fast as it went up, it came even harder back down. I wonder aloud, as I tend to do, as someone who always wonders about things and takes most mainstream media as absolute deception and fake narrative. I wonder if there wasn't a little lesson being sent to Europe that we can dump dollars to and make announcements to if you're coming too low and spike the euro in a most disorderly, undesirable point of calm. There will, of course, have been news flow that led to that, and news flow that led to it coming back even further back down, resulting in our target. Anyway, enough about that mega pump and then subsequent even larger dump that took it to a newer low. And by the way, it's a very bearish thing when something like that happens, because what it means is a piece of trade and a piece of market price behavior was allowed to happen to the upside, yet there was no stickability. Not only did you take it all back, you took it all back and some. And that's where it ended, because we're going to go into what's happening next right now. And I'm going to say to you why this is a pivotal piece of technical analysis that will lead the news before the news. You follow this channel and you follow HVF method for the simple reason that you can get the news before the news, and the news is going to be bearish for Euroland. We already know we have a FX emerging crisis. You've seen the Real, the Rupee, and many others, the Rand. And we're watching the Turkish lira, which is raining cash on our emerging market short trades, and we're using the dollar, not the euro, to take them. Now you can see why a bigger, more stable currency is about to see bad times come its way. On top of this, we've also pointed out that we expect the Canadian dollar. Well, you know that the Australian dollar has been in a multi-decade bear, and that's how they're riding out their property woes by currency devaluation. So you have, apart from the major European currencies, you know we bearish the Asian currencies generally, with a possible exception of the yen. Right through to CNY, Korean won, where we've been and correctly bearish and pointed out the property boom on Australian dollar for multi-years, and we're telling you that we see 160 on the Canadian, the better part of 158 targets, which we expect will have a bit of overrun that'll take it through the key level. So now we're actually saying to you, one of the biggest other currency in the world is going to revisit previous lows as part and parcel of trading events that we expect to have happen and occur. So why do we say so, and on what basis? Unlike others that just speculate and say, oh, I'd want to try, have a good guess and go for the news, we actually have technical validations that support our positions before we make such statements. In other words, we have a chart, we have a reason, and we have a target, and that's far more useful. And the other thing, I'll just try to keep in the bottom here, here's a little reminder line of that absolute low from 2016. By the way, that's getting on for the better part of 4 and a bit years away, past. So it's a long time ago low, ladies and gentlemen. And this has been the managed FX market where the Euroland has needed greater respite and weakness, with the possible exception of Germany, I expect, especially with with Britain and deals eventually going to have to be finalized on Brexit. It's not a safe haven for currencies, and I expect flight into Swiss franc as well as dollar. But we are going to see a dollar shortage. We are subscribers to a degree to the dollar milkshake theory, because it makes sense to us technically, because we keep getting upside setups with the dollar on the other side. By the way, we often hedge out that dollar exposure to be rather long gold generally, although we think there might be a soft patch coming up for a short while, so that we are in effect long gold against emerging market currencies. And my trade of the decade is actually BTC versus the Korean won, which also sees space for cryptos to play a role. So this is our worldview in understanding how the great machinations are going to work. And in the fiat realm, we expect dollar to be in demand. In other words, a shortage thereof. So what do we have here sitting in front of us? Well, we have that super 115 all the way back down to the lows of around 106s, the absolute low 106.359, when you tapped out on a high up top here at 114.950. So you literally just missed 115. Remember, these are big pairs. That's a big amount of pips that were shoveled around. There you are at 115, and boom, here you are at 106. That was pretty abrupt and pretty brutal. Here's your 5-hour chart. Boom, she goes. And that was ugly. Real ugly, you might ask. Since then, we've had a channeled based recovery that only took back around 50% thereof of the total move. You can confirm that for yourself. Let's do it. It's possibly a bit more. I doubt we're going to see 61.8%. It's sometimes interesting to see the degree of a bounce, so I'll show it to you while we're doing this. And you can see 50, but not quite the 61.8. Now, 61.8 as a return move and beyond tends to be more than a dead cat bounce. How much of that could we hold on to? Actually, not very much. It came all the way back down, and we're back in the blood basement, as I like to refer to it. That is the 23.6% FIB lev and below. So here we are. There's your low, quite deep in the red zone, in fact, over here. We then supported a bit there and we built back up. How far up did we go? We couldn't retrace, and I've done the 50% in black to be doubly clear. You couldn't get back up to that halfway point. See the support there, broken with momentum, attempt to regain, just run here, then the stab through, failed to make it on the return move. And actually since then we fell quite abruptly into a hammer, and this is where we're calling for our funnel. And our midpoint is, wait for it, bang on the round number of 109. Now, these you might call coincidences, being bang on the 109. To me, it's no coincidence. There's a level around which we've pivoted. We've pivoted a bit below here. We've pivoted a bit above by an almost similar amount. And so the pivots and moves around this level get smaller and smaller, and then you start to hang heavy. You start to hang heavy. So these are the areas above and below the line. We are currently trading below that line and level, and it could well be that this will be a triggering event, the 108.605 green mark. Where is the eventual target, you scream? 103.88 is the target, which probably means you will equal, possibly even overrun, with a little bit of overperformance, the 103.402, which was the last low for the Euro USD back then. Now here's what's going to happen. As this process happens and starts, all the big momentum chaser names and commentators in technical analysis and fundamental analysis are going to start screaming for how parity's got definitely on this time and the euro will fall below parity, etc., etc. It could, and it's possible, they'll be behind the curve. However, my suspicion is the control structures of the world will do all they can to avoid that actual eventuality, and that some degree of defense will occur before the parity, unless we go into simple outer space moon chase for dollars, which would then become so unacceptably extreme with the failure of all the emergings and the debts. And this is far from being an outlier call. In fact, it's probably even my primary call. In the event that you have your Turkish lira trotting through into the 7s, heading for the 8s, you have your ruble trotting through past the 75s, back up into the 90s, going possibly for 100. You have a number of other currencies like the rand, queuing up and heading for the 20s and deep into the 20s. You may have such a shortage of dollars that it will be very difficult to save. Plus our big Korean won trade going from where it is now at the 1200s to the 2100s. In such a moon spike of dollar shortage, it would almost be inevitable that all currencies, including big currencies like the euro, will be able to survive such a demand for the dollar-based debt environment. This will not last, however, forever in my view. This will be a dollar shortage moon spike, and the subsequent arrangements and results of banking failures, economic news, etc., that will be coming out of the world during this period will be extreme. The social risk will be extreme. The rioting in the streets will likely be extreme. Food shortages could well be in there. There could be a lot going on in there that's going to have you all confused and delayed and said, well, of course it happened because of these news. That's what made his lucky forecast come home of 103s and maybe even overperformance to the downside. Well, I'm saying to you, this extremity of financial event will probably be part of a precursory next stage of the reset, the same reset that we've been calling for a better part of a decade and a half. And how the whole financial system is in totally unsustainable and will continue to call for, and we could be in the throes of a totally different world and new rules. So I don't think it's going to be all good for most people, unfortunately, and I'm not going to try to put lipstick on this pig. If it oinks and got a curly tail and likes to eat its own feces, then that's what it is. Don't call it something else. But here you go. There's your target for the Euro USD, possible overperformance. Expect all the told you so parity callers to start coming in as we start running this low. That's when they'll be at their loudest. The value of being early to a trade somewhere over here, for example, and taking some profits at this level and leaving a little on for overperformance with a real method to manage is something only people in our community will be able to do, because that's where you learn how to do HVF method. And we'll tell you all about it. Book in for a call if you're interested. Otherwise, just enjoy the trade, see how you do. Don't oversize. This is not a recommendation. I am not regulated. This is the views of a technical analyst, a fundamental analyst, a real trader who trades the markets consistently and is making an outlier call for at least 103s for the Euro USD, with scope for, if we have the outlier dollar demand, potential for a parity run, along with dollar strength across the board. This will, for now, stymie to a degree the strength of paper precious metals for a while only, in my view, and then there will come the day where even in paper and against a strong dollar, the precious metals will continue to move forward, and of course the physical markets will be near impossible by then. So you know what to do. I've said it all before. Hope you enjoy the video. Catch us later. Grab a coffee mug or a t-shirt if you want to support the channel. Better still, book in for a call if you feel ready. Trading is not suitable for everyone, and as I've mentioned before in our live stream, we have 14 days money back. We don't take any prisoners, only for the willing. In fact, certain people, sometimes if it's not suitable for them, we've suggested that they don't continue and have returned funds. So it truly is a community of the willing. If you want to discuss more, book a chat below. Other than that, adios. Thank you for listening, and that's me done. I am calling it closed. Trade safe, trade small if you decide to trade. And as I've already said, this is not a recommendation. It's for education and entertainment purposes only. Okay, bye for now.